Hi everyone and welcome to this new video. This time we will be talking about 8 best Canadian dividend stocks to buy and own right now. All these stocks are dividend aristocrats and they are all close to their 52 weeks low. So first of all, before going into the video, let's talk a little bit about the interest rate hikes and how they continue to scare investors. If we look at the past 3 months, the Toronto Stock Exchange has not done really well. So it's really going down and it's a trend so far. And basically, you have to keep something in mind is that when there is a recession, stock markets are an early indicator of a recession. They are not a lagging indicator. So when the market crashes, it's usually a sign that we are headed towards a recession. And interest rate hikes are definitely something that basically causes big hurdle for the economy for everyone because businesses will have a difficult time borrowing money so they can invest, and also retail investors and everyone basically will have a difficult time. Obviously, we will spend less when interest rates are really high because they can't afford the credit as they used to before. So this is why these investors are worried, because if interest rate hikes continue, then we'll definitely have a weak economy and we will end up in a recession. So it's basically just a reflection of what's going to happen. As I said, it's really an early indicator of a recession where markets start tumbling. And what's happening behind the scenes is that investors are moving money from the stock market towards more conservative options. So you can think about large mutual funds, they're doing that, large funds are doing that. So all of this has an impact on the stock market. So the criteria to reach and to establish our list of stocks that are close to 52 weeks and they are who are considered like the right time to buy. So we have to have a dividend yield that's above 4%. So as you know, if you've been following my videos, I'm focused on passive income and investors that are long-term and seeking to build a portfolio for their retirement. So a high dividend yield is definitely something that I'm looking for. A reasonable price earning ratio. This is a great time to basically acquire stocks because price to earning is now reasonable. Like just months before or after COVID hit, like a month after COVID, we had really crazy valuations, especially for tech stocks. And at one point, it was the whole stock market that was overvalued. But now it's an opportunity to acquire stocks at a reasonable valuation. Low dividend payout ratio and sustainable dividends. That's an important criteria. You want to invest in a company that's able to pay dividends not just now or this quarter or next year, but for the following years. So sustainability is quite important, and the dividend payout ratio is an important indicator. The beta, which basically the volatility measure, has to be lower than 1.5. We don't want to end up with a stock that keeps going up and down. We want solid companies, large cap, and as I said, they have to be a dividend aristocrats. If you don't know what dividend aristocrats, you can view my previous videos. But in a nutshell, it's businesses that have increased and paid their dividends for at least 5 years in Canada. It's managed by Standard and Poor's, and basically they follow up these companies and they publish their list. So it's for me, it's a key criteria. It's a way for me also not to look at the whole stock market. Start from somewhere. So Dividend Aristocrats is a great list to start with before investing, and also analyst consensus, what the analysts are saying about the company. So the results of my query was that, as you can see here, this is my top 8 stocks. They're not ranked, like they're just random here, but this is all the 8 stocks. As you can see that the banks are financial companies are dominating the list. Basically 6 out of 8 are all financials. We have Manulife and insurance, and then we have the big Canadian banks. Surprisingly, they're all at their close to their 52 weeks low. So we have CIBC, Royal Bank, Bank of Montreal, Bank of Nova Scotia, and TD Bank. And we have also two energy companies, Enbridge and Algonquin Power and Utilities. So you have here two columns. The first one is dividend yield. As you can see, the dividend is really interesting. It's attractive. It's above 4%. And for energy companies, it's even higher. Like for this one that sells electricity at 7.28%. For Enbridge, it's 6.51. All of these are dividend aristocrats. And you can see here for how many years they have paid and increased their dividends. You can see that the average for the banks is around 10 years. Enbridge is well known for with the dividend investment community. It's a company that has 27 years that paid constantly dividends and increased them for 27 years in a row. It's really impressive. And Algonquin is at 11 years. Now, in terms of valuation and dividend sustainability, the price earning, as I mentioned, is low, is really interesting. That means that you're not going to be paying too much for these stocks. When the price earning is low, especially lower than 25 or 20, it's considered as affordable. Whereas when it goes beyond 25, and if you remember, like for tech stocks, it was a 1.400 for some of them. It was not making any sense. The valuation versus the earnings is complete disconnect there. So when the price to earning is low, that means that you are buying at a good price. You're not paying too much for the business. As you would see here, the big banks are all around 10. BMO is even at 6.85. Manulife is 4.58. So it's really a good time, in my opinion, to consider these stocks. Enbridge and Algonquin are around 20, which is still considered reasonable. Now, here is the price to cash. It's a measure of how much cash. So the lower price to cash is the better, the more cash the company has. So it's no surprise banks are loaded with cash. So they have also their dividend payout ratio, which is how much of your net income you're paying as a dividend. So if you're paying 35%, I mean you're going to pay 35% in dividends and keep 65% of your net income to invest within the company and grow. So the dividend payout ratio, the lower it is, the better for you as an investor, as a dividend investor, because it means that this company will be able to pay for next year's because it can afford it. It's paying only 30% or 40 or 50% of its net income. Whereas when a company is paying all of the net income or a very high ratio, that means that the company will struggle probably for the next years. Now, for the banks, they're all past this test. As you can see, they're all reasonable at a 35%, meaning that the dividend is sustainable. There is no risk. There is really low risk that the bank will reduce its dividends. Now, for Algonquin and Enbridge, it's a different story. These two businesses are not known for growth or for high potential growth. They operate in a sector that doesn't have a lot of innovation there. So Enbridge transports gas and it has long-term contracts. So when you see 151% payout ratio, you should not worry too much about it. Why? Because first of all, the ratio is calculated based on the net income. And net income is an accounting measure, so it's not based on cash. Second, Enbridge, the way it operates, it will always pay most of its revenues, most of its net income in dividends, because, as I mentioned, it's not an area where there is a lot of growth potential, so they're paying all of it. And also, the way they handle their business is different. They have long-term contracts and minimum quantity that the customer has to buy, whether they like it or not. The Enbridge is gonna get paid a minimum quantity before signing any contract with you. So it's long-term contract. The price are set already. This allows them the predictability. This allows them to know how much cash flows they're gonna have in the next 10 years. So this is why they're able to even pay this payout ratio and still be sustainable dividend. As I mentioned, Enbridge has been doing this for over 27 years. AQN 12 years. So, but just keep in mind, you're going to get a great dividend yield, but potential growth is low. Whereas with the Canadian banks, we all know that they are quite strong, quite conservative, nothing to do with the aggressive banking that the US witnessed during the financial crisis that causes the financial crisis. Canadian banks are known to be very conservative. They don't loan money or mortgage. They don't give you a mortgage if you don't deserve it or if you're not qualified for it. So and they are known also for growth potential. If you look at the past 10 or 15 years, Canadian banks have always done well. Now the next table is the return on equity. It's basically just how much money you're making on your investment on the equity. You could see that BMO has the highest return on equity from all the Canadian banks, but all of them have decent returns. And Algonquin has the lowest at 6.30%, and Enbridge is at 10.80%. The beta, which is the volatility measure, is really reasonable. When you invest in companies like utilities, like this AQN, you will notice that their beta is really low. It means 0.30. It means that it has historically 30% of the volatility of the market. So when there is a market crash or market spike, it will only be impacted by 30%. So if the market goes down by 10%, this stock will, on average, historically, if history repeats itself, will only go down 3%. So you want stocks that have a beta that is low and not really high, because if it's super high, more than 2 or 3, 4, then it's just a crazy stock that will just go up and down whenever there is a major announcement. So the beta here is reasonable, and so it's really quite solid companies. They're all dividend aristocrats, and they all have history of paying dividends, and they have excellent return on equity. And Canadian banks are known for their great historical like payments and performance. Now, do banks benefit from rising interest rates? As you know, now we're witnessing like the central bank is raising interest almost every month. So is the Canadian banks are going to benefit from it? Definitely on the short and medium term, banks benefit from rising interest rate, because this is hitting their first source of income, which is interest. So when interest rates rise, banks will tend to immediately pass on any interest rate increase on their clients. So if you have a mortgage, if you have a credit line, if it's variable, we will notice the increase right away. And this is how banks function. But when it comes to deposits, they're not going to increase the interest rates on your deposit right away. It takes time. And this is how banks make money, because the margin gets bigger when interest rates rise. Obviously, in the long term, if there is a recession and it stays there for a long time, banks are going to suffer, because the whole economic activity is going to slow down. And obviously, banks are related to the level of economic activity. But in the short and medium term, banks benefit from rising interest rates. And considering that Canadian banks are conservative, I don't see how they're going to not benefit from it. A lot of people mentioned the 2008 subprime, the financial crisis of 2008. That was completely different. That crisis was caused by aggressive techniques that were used by the US banks, basically lending money without any due diligence, just lending money to people to buy homes. In Canada, this never happened. It's very difficult to obtain a mortgage unless you have a good job and you provide documentation. You cannot just buy a home this easily in Canada. So this is why I don't think this will happen. This is true for the Canadian market. The Canadian real estate market is completely different from the US one. So this is just on the banks and the interest rate. Now we'll discuss 4 stocks. I didn't have time to go through all the 8 stocks, so I chose 4 of them, which are my favorites. So first of all is TD Bank. TD Bank is a major Canadian bank. It has a very good track record of growth, and the revenue and earning per share has been steadily growing 4 to 5% in the past 5 years. And they're also working on their digital presence. As you know, the big banks are being, the competition is coming from these financial tech or fintech companies. So TD Bank is already working on this to compete with these newcomers and maintain its core business. Their dividend growth in the past 5 years was 7.91%. Always, when you want to invest in dividend stocks, keep in mind their dividend growth, because sometimes a company will make sure it stays on the dividend aristocrats, but their increase or their rate of increase is really low. Like they will just increase their dividend by 1% or 0.5% just to stay in the list. You have to pick companies that have dividend growth that is interesting, attractive, and can help you with inflation, because money is devaluating with time because of inflation. So TD Bank, they're in the past 5 years, they've increased their dividend by 7.91%, and it's decent and it's an interesting. It's great to fight inflation. So it's very good news for dividend investors. The second stock is Enbridge. Enbridge is one of the largest operators of pipelines and midstream energy infrastructure. It's not a small business. It's really like it transports a lot of quantity of gas in North America. And as you can see here, they had this published in their investors presentation. What they're trying to show here is that their earning before interest, tax, and depreciation, which is a good measure of cash flow, has been steadily growing even when oil prices were up and down. You can notice that the EBITDA kept growing. And also, even during the financial crisis, the commodity collapse, the Alberta forest fires, and the pandemic. So it just shows that they are a steady company, well managed, and their cash flows have been growing. This allows them to pay dividends and never cut dividends, even in situations that are unforeseen, like during the pandemic and stuff like that. So it's a great graph, and they've done a good job showing their strength here using this graph. Now, the next one is BMO. BMO, the strength of BMO is in capital market segment and makes them less vulnerable to a downturn in Canadian real estate. BMO has the highest return on equity, as we saw earlier, and BMO is recognized in the Canadian banking industry for its sustained growth on non-interest revenue, so in the non-core business of a bank. So they are growing even in non-core business, which is really great. And their dividend payout ratio is only 32%. So the risk that they will cut dividend is really low. BMO has also a net income growth, interest in net income growth, and low dividend payouts. Is a good buy for any income seeker investor. And in the past 5 years, they grew their dividend by 4.51%. It's not a high increase, but still it's decent, and it's welcomed. Royal Bank is one of the largest banks in Canada, and it operates in 5 different segments. This allows them to generate profits in various segments. So even if one segment is impacted by the macroeconomic environment, they can still survive. They offer an attractive yield at 4.19%, and the dividend payout ratio is 51%, and they have 10 years of consecutive dividend payments and increases. In the past 5 years, their dividend grew 6.92%, and their beta is only 0.87. So I hope you liked the video. It's basically just taking advantage of the recent correction to identify stocks that are now a good buy, in my opinion. So it's always a great. I read something about Warren Buffett, like he mentioned, when there is a correction, that's where you want to go and shop. It's like when you enter a store, if they are doing deals on everything, that's where you want to shop. It's not what that's. It's not. He never saw someone go out of a shop if everything is on discount. So if you want to read the full article, I will post the link below. And also, please, if you like the content, please like and subscribe. And thank you.